I wonder if we're going to be in a situation where we're going to be waiting for Godot, right? We're going to be there, or the market's going to be there, waiting for that strike before making a decision. Hello, and welcome to this episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research of Onyx Capital Group, and I'm joined here today with Martha Dowding and Vincent Wu, both research associates at Onyx Capital Advisory. So after taking 2 weeks of break from the world of oil derivatives, Onyx has come back with a multitude of shows. So we have a whole bunch of new content heading your way. And this show is going to replace World of Oil Derivatives going forward. And so keep a lookout for not only this show, but all the new content that we will be posting both on LinkedIn and on our YouTube channel. So the oil market has been on a wild ride in the past week and change, selling off violently amidst unwinds in other asset classes, notably FX and the yen carry trade. The risk-off mood across risky assets did, however, stabilize, with oil back now above $80 per barrel and seemingly pointing higher. The VIX index, the volatility indicator of the S&P 500, and of course a measure of nervousness, has retraced more than half of its spike of the 5th of August, indicating that some of the jitters that we had last week have subsided, and even as more position unwinds are likely to be coming forward. Now, the rally in the flat price that we've seen has come in tandem with a rally in front-month Brent Futures spreads, suggesting that the market is tighter, but we haven't had any real apparent fundamental signal of that. When it comes to the fundamentals, we just had the release this week of both the monthly oil market report from the OPEC Secretariat, and today the IEA's release of its monthly oil market report. OPEC has finally decided to revise down its growth forecast for global oil demand this year, even though it's sticking to a 2 million barrel a day growth figure. The IEA itself stuck to its guns with a sub 1 million barrel a day. But both reports have highlighted, obviously, fragility around the outlook for China's oil demand. So the fundamentals that we have are not necessarily supportive of a sudden rally in prices. Now, if we start looking outside of the fundamentals and technical indicators, what we're looking at is prices bouncing off the lower Bollinger range, crossing short-term moving averages to the upside, and that could be enticing some momentum players back into the game. And finally, of course, there's geopolitical risk premia and the escalation of tensions between Iran and Israel. And we're going to be talking a lot more about that in the podcast. And perhaps there's some positioning changes that are taking place since the last set of data that we had, positioning ahead of an eventual retaliation of Iran on Israel. So we're going to start off with looking at Brent, and what I want to do is start with positioning, because at the end of the day, that is what is the most likely driver of the rebound that we had in oil prices since the meltdown of last Monday. So Vincent, I would like to start with you. Could you give us an update on the positioning of money managers on Brent Futures? What has been the direction of travel, at least as far as the data can take us? And then where do we stand in terms of capacity for risk? What's the long-short ratio? What are we looking at?
Yeah, so from a money manager perspective, they have been getting significantly shorter in Brent Futures according to the latest data, not only in Brent but across the oil futures complex as a whole. So it's not only a combination of longs liquidating their positions, but there's also been a huge increase in short positions as well, new positions, so much in fact that the long-short ratio in Brent has been pushed down to 1.09 to 1, which is in the first percentile in the past decade. So the weakest positioning, even weaker than peak COVID in March 2020, which really shows something.
So technically the funds right now have a lot of firepower at their disposal, and they could be ready to tip a toe back into the market under the right signals. Now, when it comes to the movement in prices, We've been looking at a flat price that has certainly recovered above $80 per barrel, but we also saw spreads on ICE Brent futures strengthen. So I'm a little bit curious as to whether or not the strengthening within time spreads or the structure of the curve has filtrated down to what we see in terms of structure in swap markets when it comes to DFLs or CFDs. Can you tell us a little bit more about how those behaved recently?
Yeah, sure. So in the CFDs, DFLs, it's the underlying North Sea crude physical market. It's seen an exceptionally volatile performance. So it came off in line with the Brent sell-off 2 weeks ago, and rallied back up just as quickly. Really encapsulates the herdy mentality of the markets, but also the significant movements. So the physical differential and the CFDs went into a contango structure and then back into a backwardation that was even stronger than before.
So a lot of whipsaw what we're seeing right now in these spreads.
Yeah, huge whipsaw. It's as if the market's stronger than ever before. So even though you have the bearish macroeconomic sentiment, the physical market certainly isn't believing that. We're seeing strong backwardation in the time spreads, indicating that the crude demand is robust, at least in the short term. And so from the flows we've been seeing, previously it's been a couple of refiners popping up the market, and initially the sell-off came from these guys stopping their buying flow. So Chevron, Equinor disappearing from the buy side, and then TOTS are selling in the physical. And then last week we had Vitol come in to buying up all the physical, buying up the physical, and then we're having guys like BP, Shell, and Unipic join in. So it's a very herdy mentality, and it's difficult to say. At current levels of backwardation, the question is, can that be sustained? Because if there's not enough genuine demand, then we could see refinery cuts and run rates at this point.
It's certainly interesting that the DFLs reacted. Refiners were on the buy side, obviously a little bit concerned about the availability of crude, but as you're indicating in the window, even though there were some actors that were popping in there, buying and trying to hold up the complex, at the end of the day, there was a lot of people who actually did have oil to sell in the window. So from that point of view, the question is, while the DFLs have reacted in line with the spreads on futures, maybe the spreads on futures leading a little bit dated in terms of direction, it's hard to really say whether the strengthening that we had in differentials is one that is indicative of a true fundamental scarcity, or one, as you're saying, of herd mentality, where as the flat price and ICE spreads moved higher, the rest of the complex just simply followed through in unison. So we have a situation where effectively, both from a CFTC point of view and from Onyx's proprietary data when it comes to estimating CTA's positioning, which basically allows us to say, well, yeah, there's a lot of capacity to put back on risk. And the question is really, what was the trigger of that capacity? And we're going to probably be able to discuss a little bit more about that, especially when we start thinking about what's happening in the news. So if you just Google oil in the news section, and the word that pops up all the time is Iran. So seemingly geopolitics is enjoying a resurgence. This past weekend, Iran has reiterated its plans to retaliate against Israel. And so the question really is, we have a situation which has been developing for some time now, with the U.S. now moving a lot more military assets into the region with an effort to de-escalate. So is this geopolitics, sufficient in terms of propping up the price? So Martha, what are your views in terms of how the geopolitics plays out in this recovery that we had in oil prices?
I think comparing to the last time that we saw the situation flare up in April, we can see a lot of similar themes, but I think this time it seems a lot more serious. In April, we saw a 2-week wait for the Iranian response from this drone strike in Damascus, killing the military leader, to this missile and drone attack into Israel. And then we had that weekend wait, we had the worry of the market, everyone was pretty risk off then, and then we saw some attacks near the nuclear facility. And all in all, this was kind of seen as a very choreographed.
Almost telegraphed, right?
Yeah, it was kind of, they're flexing their muscles, but they're two barking dogs on leashes. They're saying we could get the nuclear facility, but we didn't. And I think we saw these missiles. We saw a drone or two pass through the Iron Dome as well, which I think was a little worrying to people in Israel and Israeli commanders who see this as just like an absolute trump card all of the time to protect their people when this drone strike, which they had such a long time to prepare for, almost on purpose, to show, this is what we're doing, but it's not as bad as it could be. We could be doing this immediately. Things did still pass through the Iron Dome. So I think the market reaction to this was during that period of wait, there was this building in flat price. And then as the market saw that it was this kind of choreographed move of kind of like a few chess pieces moving, the market then softened and reacted, and people were like, take a breath out.
You think that this time the choreography is not quite there yet to have people fade the geopolitical risk premium? You're saying it was a little bit more serious. Obviously, the U.S. have stepped up, bringing in a carrier group into the Middle East. They have sent F-22 fighter jets. They even have a submarine with guided missile capability. So obviously it's looking a little bit different. And I guess, when it comes to geopolitical risk and people who have now the capacity to take risk while waiting for this impending response. And we're still waiting, because when I looked at various commentaries by pundits on various news networks, I mean, they were positing that the strike would happen within 24 hours or within 48 hours. So I guess Iran is probably carefully planning what kind of response it's going to have. The question is whether or not we get preemptive movements by Israel ahead of this. It's probably a lot less clear, as you were saying, relative to the previous instance. Now, Vincent, I mean, when we talk about geopolitics and geopolitical risk premium, especially in this area of the region, it's always an issue of whether or not this could develop into something that could threaten either oil production, oil infrastructure. Imagine retaliatory strikes on Iranian oil terminals in a worst case scenario, or even simply the transport of oil, because obviously the region sees a lot of flow of oil. What are your thoughts in terms of how this geopolitical risk premium could persist or not? Previous instances, we eventually faded the geopolitical risk premium. It was an opportunity where people saw in a proportionate response an opportunity to sell the increase in prices. Is there anything different this time around in your view?
I think there's still a lot of uncertainty, which is precisely why there's this geopolitical risk premium. I would say that even if production or oil transportation infrastructure that is disrupted, the market will price in that fairly quickly. So you had the Houthi attacks on the Red Sea shipping that affected a lot of oil prices, the east-west, but eventually the market has priced in that. Maybe if something happens that surprises the market, it will continue for a few months, and then they will always be needing new stuff to kind of sustain this geopolitical risk premium. But I would say, there's always been talks about, what if the Strait of Hormuz is shut? What if that gets disrupted? It really isn't in Iran's interest to close that, because ultimately a lot of their crude gets exported to the main customer, China, which and it's also a huge source of the country's revenue for Iran. So it's not
It certainly
in their
risks turning a number of countries that perhaps keeping a more neutral stance, who are dependent on the Strait of Hormuz to get their oil out to Asian customers and Western customers, the likes of Saudi Arabia, Iraq, Kuwait. Perhaps Iran moving into that kind of a dimension is maybe on the more extreme scale of escalation outcomes. But at the current juncture, what we find ourselves is now, and I wonder if we're going to be in a situation where we're going to be waiting for Godot, right? We're going to be there, or the market's going to be there, waiting for that strike before making a decision. So yes, from a positioning point of view, the positioning of risk takers is a lot cleaner. They could take a gamble on the nature of an impending Iranian reprisal on Israel, or certainly when that happens, prices are likely to have somewhat of an uplift. But at the end of the day, depending on the type of response and whether it's judged to be a proportionate response or not, and what that may lead to, is going to be telling us how long the premium is going to be staying in the price. And speaking about price, this is where obviously our poll of the week is quite simple. We sank to almost $75 per barrel on Brent following the meltdown in markets last Monday, and we bounced back, and now we're trading back above $80. So the question is, given what we just said about positioning, about a lack of fundamental impetus right now, do you guys think that we're going to be able to hold this $80 going forward? Martha, what do you think?
In my opinion, I think what it boils down to is when you say Googling oil, the only thing that comes up is this Iran story. I think the support that we're seeing in the flat price has been completely centered on people looking for a positive story. We've seen really poor demand figures come out recently, and we saw the manufacturing data a couple of weeks ago in the US being shocking. The China foreign funds being drawn out to like their lowest level. And I think people are seeing this as a bullish story that everyone can kind of jump on. And the longer they leave it, the happier people are to commit to that, as we've been saying. And, the US being like, oh, get ready, it's going to happen. I think this is, propelling it. I don't really think these levels are sustainable. Fundamentally, the picture isn't better. Refinery margins aren't good. And I think that once this kind of fades, if touch wood, this is not a large military response, then I think players will kind of snap back to reality and see that we aren't in a better position than we were a couple of weeks ago in terms of fundamentals, in my opinion.
So Vincent, are you on the same line and in terms of sustainability? Can we hold this $80 going forward? Is it just a matter of time until we find out what the response is, after which we turn back to where we were, as Martha was saying before, an economic, a string of economic data, certainly out of China, that hasn't been favorable. You highlighted, Martha, the US, but it's also the case in terms of industrial production, manufacturing in Europe. And then, of course, there's a lot of uncertainty as to how central banks are going to conduct policy. So, Vincent, do geopolitics carry the day until we have a response from Iran towards Israel, if that response ever comes?
Yeah, I would say so. Yeah, I do think this $80 level is sustainable. It's not only just the geopolitical risk. Oil sold off to $75. We didn't even need OPEC to jawbone the market up again. I think it's in a very tight range between 75 to 85. So, of course, depending on the response, if it does disrupt production, that's a chance for Saudi to utilize their spare capacity, bring barrels back to the market. But ultimately, if prices fall further, then they will need to continue with their output cuts. So, of course, OPEC is the big wild card, and we do think no matter what happens, they do want to keep the price floor. But it also depends on some key macroeconomic data this week. A lot of things coming out of US inflation, but also I believe China industrial
Yeah,
production, retail
we'll be
sales
looking
will.
at that. But so, I mean, bottom line is, Martha, you're a little bit more pessimistic on the market being able to hold on to this, because maybe the reasons why people have put back on risk are going to be essentially contradicted by how events play out. Vincent, you're a little bit more on the bullish side, saying that there is obviously, in terms of this premium, a little further to go. Sure, OPEC can always be viewed as an insurance policy, assuming, of course, that the nominal Saudi spare capacity is also available to be utilized and exported in the case of a wider conflict. I tend to sort of navigate towards the mean reversion of where we were prior to this weekend's announcements by Iran towards Israel. I think that the fact that we had capacity for adding risk, as you guys were highlighting in terms of the positioning, has been such that you could dip your toe back into the market, and the geopolitical uncertainty is certainly one where you're either adding length to flat price, buying spreads, or simply buying call options on an event risk. If the event risk doesn't materialize or passes as in previous event risk, then we're back to where we were a little bit earlier. Now, moving away from crude, we're in Oil Insights every week. We're going to have a focus on a particular product. So this week we're going to be looking at gasoline because at the end of the day, we're now pretty much a few weeks away from the official end of the summer driving season, and gasoline is somewhat disappointed when you look at the weekly data. It seems that the data has been underestimating the more complete monthly data, but the market trades off the weeklies and not the monthlies. So when you look at gasoline, performance on cracks over the past month has been also relatively lackluster. I'm going to turn to you, Martha, and basically, what has been happening on gasoline? Let's start with maybe positioning, and then looking at how these cracks have evolved in the swap market.
Yeah, of course. So starting with the CFTC positioning for RBOB, the American gasoline benchmark, this is backwards looking for the week to the 6th, because that's the most recent data release. The positioning by money managers, which like speculative funds, they essentially have no bullish confidence in the market right now. The ratio of their long to short positions is in the 3rd percentile for all weeks since 2013. We're in driving season. It's just, I mean, it just seems mind-blowing that it can be that low, which on one hand does show, they're extremely bearish, they have no faith in the market, but this does leave a gap for something bullish to come along and like a spur of short covering and closing positions for prices to be really supported by these funds. And I think it's important to not forget the CTA positioning. As we've mentioned earlier, the CTA positioning in, all of the futures that we look at in our CTA net positioning model from Onyx, it's extremely, extremely low. We haven't seen levels a lot lower than this before. This is seen kind of like a support level. So if CTA positioning can't really get much lower, if the fund positioning can't really get much lower, where do we go from here? We could see maybe like a debt cap bounce up, and then if nothing bullish happens, we could plow further down. But in terms of a bullish factor to look at, the weather is, well, I know in London it's extremely hot, but I think in Europe we're seeing some heat. But in the States, the focus is in the Atlantic Ocean. It is hurricane season, and we saw, of course, Beryl earlier this year, and La Nina, which is the weather pattern, thank you, that we're kind of in the middle of right now. We have 4 to 7 major hurricanes still forecast. Of course, they're not forecast for landfall, and they're not directly going to impact the refineries, but I think this could be something bullish, that once we have a named storm coming to land, getting a decent landfall predicted, this could be something that the market looks at as kind of this long-awaited spur for bullishness. But
So we really have you're describing a very binary outlook in essence. Either it's weather-related risk in the form of a hurricane that could obviously come to affect refinery operations, or extreme heat that also could affect refinery operations, and that could give a bit of a leg up to the flat price of gasoline, and of course push the crack higher. On the other hand, absent these weather factors, if the economy is not doing better, if unemployment is rising, if the rest of the summer season is looking a little bit glum, then we may have the possibility of looking at refiners accelerating prompt hedges. And of course, that just means that they lock in their margin, and that supply will be available for next month. And the end of the summer driving season in the fall could be a very bearish one for gasoline. Have we seen any movement by refiners as of yet from our own proprietary data?
Yeah, so looking at the Onyx proprietary data in terms of counterparty type, we're now looking at the European crack, the EBOB crack. So the most significant movement in net positioning in the past 2 weeks has been actually from trade houses. So physical trade houses have bought a huge deal of the prompt EBOB crack from Onyx, which has been about 800,000 barrels in the past 2 weeks, bringing their net positioning to 2 million barrels overall that they've bought from Onyx. It's been exponential recently, well, of course, as it's the prompt. But we've also, interestingly, seen a little refiner buying in the crack too, which could be the unwinding of hedges, and they could see maybe some bullish position, like bullish movement in the future. Or, I mean, it could suggest maybe that they're producing less.
Possibly. I mean, certainly the you highlighted early on there has definitely been an erosion in terms of refining margins. The individual gasoline cracks, whether it's EBOB against Brent, RBOB against Brent, or RBOB against TI, they've been holding afloat not so much from the strength of the product, but thanks to at least accepting the most recent period weakness in the crude price. So for our positioning is basically saying that there are some people who probably believe there's going to be a little last spurt in the summer driving season, because right now the flow, in terms of trade houses, obviously they don't have retail distribution networks or petrol stations. So if they're buying up gasoline and getting ready to obviously deliver it somewhere else, they're maybe looking for that last uptick before August closes, and then we move into September, and demand for gasoline seasonally winds down. Now, I would think that when it comes to gasoline, the last thing is just sort of looking at the ARB, and what is the ARB telling us?
So looking at the transatlantic ARB, the difference between RBOB and EBOB, the American and European gasoline benchmarks, we have recently seen some physical players selling the ARB, which suggests that they're buying the EBOB and selling into the US, which could potentially indicate a little bit more demand in the physical to have that ARB play. But we haven't seen these in huge volumes. We have seen a little physical selling in the window, but it's just hard to say whether this is.
So it may be a little bit difficult to connect with. I mean, if you have independent physical trade houses getting long on gasoline, and then of course basically hedging the transatlantic ARB, maybe there's an element there where they're maybe locking in now the opportunity while it still remains. So gasoline, I mean, if we take away weather risk, it's not a particularly glorious picture, right?
I'm not bullish in it. I think in EBOB now it's flattened a little compared to RBOB, which has definitely sold off in the past few days. But I think it's little more to go from here.
Well, we're now approaching the end of this episode of Oil Insights. So to conclude, Martha, Vincent, Martha, starting with you, what are we going to be looking for, especially in terms of gasoline this week? What's our focus going to be?
Of course, looking at the refinery margins, really important, whether refiners are buying or selling with Onyx using our counterparty dashboard. But also looking at the US EIA data that is released tomorrow to see how gasoline demand is performing. As you did mention earlier, there has been these huge adjustments made between the weekly and monthly figures. So it will be interesting to see how much weight the market is willing to put on these stats. I think that'll be really interesting.
Vincent, for you on crude, what's the focus this week?
Yeah, so apart from the geopolitics side, of course, there'll be the macro data. So firstly, the US CPI, which comes out tomorrow on Wednesday, which will submit expectations around the Fed and whether or not it will cut interest rates in its next meeting in September, but also some key data from China coming out, so including industrial production, retail sales, and fixed asset investments, which is in English, that's property sales, which will shape expectations on oil demand, especially since Asia's expected to be contribute to a strong part of the world's oil demand growth. So naturally, people will be looking into China data and putting a lot of weight on that.
Yeah, definitely. And today's International Energy Agency a monthly oil market report came out and probably surprised people with their estimate that Q2 Japanese oil demand actually contracted slightly in excess of 100 kbd. Now, before leaving you guys, I'd like to mention that Onyx has launched on its website, available for free, our proprietary commitment of trader data aggregated in a CFTC style of classification. I really invite you to go and check it out. It is a new product, and we're going to be developing our proprietary dashboards even more. So please go have a look. As we conclude this episode of Oil Insights, and we look forward to seeing you again next week. So don't forget to smash that like button and subscribe to the channel if you haven't done so already. And please look out for new Onyx content coming your way. Thank you very much. Thank you, guys.